Well, hello there, everybody. This is Morris from San Jose Options. And, well, the news is out. There's been all these questions and buzz around the options industry for the last couple of years. And everybody's been wondering, how Karen the Supertrader was making all of that money. And a few months ago, I performed extensive back tests on the short strangles. I did a search in Google and I found Tasty Trades formulas, and so I actually had the programming done so that we can back test, automate the back test because it's an awful lot of work, and have that done and produce those reports. And I created some videos and articles on the back testing, and some people were in disbelief that they were accurate, but they were extracted and derived from the historical data that comes directly from the CBOE. And again, we can look at those. So we did a few different back tests, and there's one here. Again, on the website, you can find this. It's in an article. And then in this test, we used 5% of the margin, and then we followed the rules that were given by the Tasty Trade Network. They're posted in here somewhere. And this one, after a complete 11-year back test, it increased the portfolio by 5%. And here's the formula here. We were selling the 16 Delta, 45 days to expiration. And then we even used a 50% to 100% IV rank. And so that made 5%, and that was using 5% of the margin. Okay, so then I tried different allocations of capital. So I was experimenting with the money management. Here we used 10%, and we got up to 9%. Okay, but remember, this is 11-year back test, so it's not even 1% a year. And then I bumped it up to 20%, and then the system started to lose. You can also see by the reports that I published the results in great detail for every year. And we also replicated the margin system that TD Ameritrade was using. I know they modify it slightly. And then we did a test here of 30%. And the portfolio lost 18% over that period. So the more we used, the more this started to lose. And then there was another test. Okay, so here I did another test prior to that one, and then I typed in the results instead of using the images. But here I did some other ones, and I did the 50%, where Karen supposedly was trading somewhere between 50 and 70%, according to one of her interviews. And you could see over an 11-year period that the backtest lost 44 to 93%. And then according to the SEC reports that just came out, it sounds like she's lost about 50% of her capital, because there was, if you look at the Credito.com, unless, I don't know if she's been removed from there, but the last report showed she had like 250 or 270 million, and then the SEC report showed she only had like 116 or 130, something like that. So there was over $100 million missing. So I think she's probably lost somewhere between these amounts. And that was the same as our back test revealed. Okay, so this is a portrait of the short strangle. And this is constructed similar to, what she was trading. This is selling out of the money somewhere around the 5 delta on either side. And you can see that there's just a little bit of profit here, like just a hair. But, with any significant move, look how much you can lose. And just visually looking at that, you should understand that, wow, there's an awful lot of risk in this trade for very little profit potential. Okay, so I assume that someone on the inside, maybe one of her investors found out that, the fund was losing. And then the SEC performed an investigation. And then the links are here. You can find them online, but there's an entire report by the SEC. And I also want to point out, I think in a lot of ways that Karen here is a victim of the industry and a victim of the software that she was using, a victim of the margins and all the advertising and the hype around the short strangle, her education that she had, and a lot of things. So, I know that, she's being accused of fraud and things like that, but, in a lot of ways, I think she was a victim of the circumstance, and then she couldn't find her way out, and just started to, and came up with a way to cover it up. But if you read through the article, you'll understand, some of the shortfalls I think that the industry delivered to her that sort of led her down this path. Okay, so Tasty Trade's already been deleting all their videos and all their articles and everything about her. And again, you wonder, because they're the brokers and they have access to her account, so I guess it's obvious, like the elephant in the room, as they say, but they must have known, right? Because they had access to her account, so they should have known that she wasn't making all that money. Now, again, if you follow Tasty Trade, you know that the Strangle is one of their favorites. And again, that's why I performed the back tests. And again, I found out that if you trade really small, 5 or 10%, then that method can make maybe 1 or 2% in a year. But when you trade 15% or greater, it starts to lose. And so, and again, the whole story is just quite interesting. But yeah, it's a Tasty Trade favorite, and I've been trying to tell you guys that it's not really quite the strategy that they make it appear to be, because a lot of their tests they're short tests. So they may choose like 5 years where the market's going up and do like a bull put spread or something, and then, so one could really argue that they're cherry picking a lot of their tests. Or they're curving, the tests so that the results come out good. And that's why when I do the tests, I try to include all the historical data that we have, 11 years, 15 years, whatever I can get included into that back test to see how, to test every system thoroughly. So what Karen was doing was really, again, from what I gather, I don't know her, but from watching the videos and things, she was selling something around 58 days, I think. And then she was selling her naked puts and naked calls, way out of the money, some around the 5 delta. One time I think I heard that she was selling the call side in a little closer, maybe the 10 delta. And then, again, supposedly as the market went down, she entered into the puts, and then as the market went up, she entered into the calls. Nobody really knows exactly what she was doing, but supposedly she was doing about these, 2-month short strangles. And again, from looking at Credeo.com, where it posts information about registered advisors, and then comparing that to the SEC report, I think they lost over 100 million. Again, I'm just estimating. So it's just really important that the public understands. Again, it's probably too late for a lot of you, because I know could be hundreds or thousands that have been trying to do the short strangles, based on all these advertisements, and maybe you've already lost quite a bit. So I did what I could, to try to address the risk involved with these methods, but I'm only one person without funding, so it's kind of hard to reach people. So next, we'll just look at that trade in general and study it a little bit and see, what's really wrong about it. What are the weaknesses of that trade. So first of all, there's a lot of directional risk to Karen Burton's strategy, or to the short strangle, but now she's always going to be associated with that type of trade. But again, if you just go back here, and so the gamma, the negative gamma, it represents how fast your delta is going to change. And so, for example, right here, the trade looks fairly flat, but then with just a small move, you see how the curve's changing and your delta's changing, and it's caused by this negative gamma position attribute that's created. So the thing is, when the market, or whatever, the SPX she's trading, moves down here, then it starts to lose, and as you go this way, it can start to lose as well. And so again, it's a pretty sharp curve there, and it's just has a lot of directional risk. So that's one of the first weaknesses about this trade. But this is where it gets more interesting, and where most option traders, are not aware of, is the VAMA. But the Vega position, since the trader is selling a call and a put, they're creating a negative Vega position. So again, if we go back to that chart, when the market goes down, or when the SPX goes down, there's an inverse correlation of the price to volatility. So if you go from here to here, and let's just say this is 10%, there's going to be an increase in volatility. Okay, and then you can study the correlations to figure out how much on average. So since the trade has a negative Vega, when you get here, this is not your risk. Not right there. Your risk is actually farther down. It could be double. Okay, so again, this is something that maybe Karen was not thoroughly aware of. Okay, because unfortunately the education out there doesn't get so deep into price volatility correlations, how it impacts your Vega and things like that. Okay, so I don't know. Maybe she was just modeling her trades and she wasn't injecting any volatility, or maybe she didn't know how much volatility to input into the Black-Scholes, and she didn't know what her real risk was. So think about that, and also the way that the TIMS model works, unless they've changed it, but in the past it didn't measure any volatility risk. So then it would just measure right there, and that point would be your risk, or this would be your risk here, and so on. So, think about that before you judge Karen. She, very possibly was not aware of that, because the margins most likely didn't even reflect an increase in volatility. Then as you go this way, it's a similar situation. Again, the margins by the various brokers may just be looking at this one line, the day step line. But typically when the SPX goes up, the vols are relieved, and they drop. So as we go this way and the vols drop, then this dark line would move up, and you'd have a little bit of a profit. Okay, so that's kind of how the Vega affects the position. But then if you get into Vega even farther, and this is where really the education stops and we start SJ Options and SJ Advisor. And right here, so VAMA. Okay, you might hear some people say VOMA. I just don't like to mix languages together, so I call it VAMA. And the VAMA of this position is negative, and it's pretty strong. So what happens is, as I just explained, when the volatility goes up, so again, we're talking about the VAMA position. So as we go this way, then the volatility increases. Your Vega position is negative, so the trade loses. And I could even draw on the screen here a little bit. All right, so where price is moving this way, right? As you go this way, what happens to volatility? So your implied volatility goes up, right? Price goes down, vols go up. This trade has negative Vega. So when this happens, vols go up, your negative Vega start to lose money. Okay, so let's just say minus whatever, 10 million. Just tons of zeros. Okay, so 10 million, so we lose 10 million here from the Vega position. Now, you can also see the curve and the line from the delta. Okay, so we're also going to lose from the delta. So let's just say from the delta we lose another 5. Another 5 million. Okay. Now there's another Greek, which is a higher order Greek, called the VAMA. Okay. And the VAMA is negative. Okay, and this is where pretty much the industry is lost. Where, again, I don't like to be pompous or whatever, but we've been working with the higher order Greeks for about 7 years now. Okay. So they just, options intrigued me, and I obviously really got into them, and then I got into software development and everything, and working with higher order Greeks. So anyway, these are things that, are really important to traders, especially if they're working with the naked positions, and then is what happens when you don't understand them. So as we go down, volatility goes up, you lose money from the negative Vega. We're just saying 10 million. You lose money from the delta. Okay, it doesn't fit, but lost 5 million there. But now the VAMA. Okay, so as vols go up with a negative VAMA, you have a negative VAMA, negative number, times positive change volatility. Guess what happens to your Vega? It becomes more negative. So you may, I did the math on, it's farther down the article, so I can't remember. But I think she had like, just an estimate would be like negative 2 million Vega to start with. Okay, so every point increase in volatility with this large size of a short strangle, you know, her account was losing $2 million every point the vols increased. Okay, so back on August 24th, how much did volatility go up? I don't remember exactly, have to look at the chart. But let's just say it went up 20 points, okay? And she was trading short term, so that increase in volatility of the VIX would be pretty close to what she experienced. So if her Vega started at negative 2 million, and let's just say the vols went up about 20, that's a loss of $40 million in one day. Okay. And that's just the beginning, Vega position. But guess what? With that increase from the VAMA, your Vega changes to negative 3 million. Okay. So this is even greater. So this could be maybe like minus, let's say, 55 million. So at this point, if her account had, and it may have lost before that, but let's just say it started with, let's say it had 200 million. Then in one day, you know, it's looking at a drop like that. So down to 145 million. Okay. Now at the same time, the price moved from here to here. Volatility crunch pushed this line actually down farther. So let's say this is you are here dot. All right, now the risk model measures down another 10%. So your new margin happens to be over there at this point after a decent move. Okay, so your margin on a trade could have started here, and then after one day, now your margin requirement's down here. So you can see that it can go up, it can double or more. Okay, so that means, let's say she had started with 200 million, and if she was using 50%, so she's using 100 million in margin. You go here, now the margin goes up double, so now her new margin is 200 million. But she started with 200 million, and she just lost 55 million. So now her net liquid is 145 million. And her margin is 200 million, so now she has a margin call of $55 million. Okay, so that's what happens with this trade. Okay, and so if you're not understanding, you're not privy to VAMA, you don't understand how your price to volatility correlations work, if you don't understand that your negative 2 million Vega is going to change to negative 3 million and negative 4 or 5, and the more you go down, the worse this Vega position can get. There's another Greek called Vana that I'm not mentioning in this video, but it's another one that affects your Vega position. Okay, so these are some of the complexities that I'm sure Karen's not aware of, because when I saw the interviews, you know, she seemed to understand delta, but not really, you know, it seemed like she was saying like, well, I go down 10% and 10% more or whatever, and she was basing, you know, her short location on just a percentage away from the price. And it's kind of strange too that she would speak that way after, you know, she took a couple courses. So let's turn this. Okay, so I covered that. So that's what I mean by the accelerating Vega risk. As the market goes down, your Vega gets worse and worse. And that's what happened to her. Okay. Another problem with this short strangle is the margins are extremely unstable. And as I just explained, with one fast move down, your margins can go up double, while simultaneously your account value drops, and then they meet and cross, and you get a margin call, or you get a serious account liquidation. And if you search the web, you'll find that your broker is not so friendly when it comes to liquidations, and they destroy your account. It's hot. Today's like the hottest day of the year. I don't know what's going on here. So, drinking some cold water. Okay, so I just explained a lot of this. I already talked about the back test and showed some of those, and you can look at the reports on here. I didn't fudge them. They were just programmed, automated, and I did those tests the best that I could, and if there's, there could be computer errors, whatever, or errors in the CBOE historical data, but that's about the best that I could do. So down here again on August 24th, if you were watching Soznov and those videos, he commented, these are just horrible, horrible days for Karen Supertrader and for himself. And I seriously think they, just like we just calculated, they could have easily lost 50 million on that one day. And again, I'm not blaming Karen. It's just the industry. They like to tout this method, and it's extremely risky. And I've seen just a lot of people. Again, I can't mention any names, but I saw two other similar situations. So I was talking to one short strangle trader over the last year, had account go from 1 million down to 500,000, and he was doing 45 days strangles. I don't know if he was following the tasty trade thing exactly, but he was doing them 45 days out, and then he was searching for high volatility, and I saw the statements, so I can verify that I saw that. And that person, lost 500,000 in 1 year doing this. And then I also knew another trader that had a group, and that trading group also lost $6 to $7 million, wiped out the account in one single day also. So, that's why I kind of feel like, well, I have a duty to inform people. And also, I tried this too. I fell for some of the hype, and I started to study this. Luckily for me, I didn't do that much, but I did do one small strangle. I think I had less than 10 contracts, and it lost 14,000, which is a very small increase in volatility. And so I even played with this and experimented and just tried it once and found out, it just certainly wasn't what it was hyped up to be. So the next thing I'll talk about, and I mentioned this, but again, your margins here, they'll double in a heartbeat, and you really have to be conscious of that. And so it's a serious problem with this method, because if you think about it, if you're only using like 5% of your portfolio, or maybe 10, and I showed you the reports, and the problem is you're only going to make like 1 or 2% in a year. Okay, So naturally, the trader wants to use more. But the problem is once you're using like 30 or 40 or 50%, then you're vulnerable to the margin call because your margin will double and then your account goes down at the same time, and boom, they cross and you get that call. So that's the problem with this. So make sure you're aware that it's really risky if you're trading more than 20% of your capital. Because the other thing is people, they always think that they can get out. Like you'll have a down day, and they'll plan ahead. Maybe they'll say, oh, if I see a down day, I'm going to just exit. But in reality, when you have that down day, you lose a bunch. And then you're like, well, I don't want to exit now because this is really the time to enter. And then guess what? 1 or 2 days more, like August 24th, and boom. So, in my opinion, it's better to just not do that trade because then you put yourself in that situation. So another thing that she was doing is just rolling those trades farther out in time. And again, that's a common, it's like a deep pocket method, that some people try to do, but awfully scary. I've tried it before as well. So, it's going, let's say the market's trending up and up, and then you just roll, you close the one trade out as loss, and then you open up, trade farther out in time, and then, you have to, typically you'll want to size up, at least, people that do it, I guess. But then that takes more capital, and then you put on more risk, and then if you're wrong again, if the market keeps going up, then you dig a really serious hole. And it seems like Karen was doing that. Just kept digging holes deeper and deeper and deeper. So here in the software, I built one of these traits. So I supersized it, and I was trying to use, I don't remember, I did this a while ago, but I think I was using like $1 million buying power or something like that. Okay, so it was 15,000 naked puts and naked calls, and then they were around 5 deltas, and then I noticed in the software that it had like a negative 2 million Vega, and then the Vega position was negative 140, and then with the increase in the VIX or the volatility, the Vega shifted to negative 3 million. And so that's reality of that trade, and especially when you're trading like $100 million. Alright, then I explained this before, with the picture. But again, as the market goes down to the left, in case you didn't get it the first time. So let's say that you're at the monies here, and then the way the TIMS works is it just measures down and up 10%. So let's say that this is the 10% mark. This is your initial margin. Okay. Let's call it the IM. So your initial margin is right there. Then, as the market actually moves down to this point, let's say we move down 10%. So now you're here, but then with the volatility increase in the negative Vega of the position and the negative VAMA, you're not there. You're way down here. Okay, so the first problem is the risk model calculates your risk is here, but your true risk is really here. So now you're at this point. Okay, so this is where you are now. And then your margin is measured down another 10%. So over here. Okay, so this is your margin after. So your margin starts here, initial margin, and then we'll just say your ending margin is right there. So your margin goes from here to here. And essentially, if this was, 100 million risk, now it's 200 million, and that quickly your margin can double on that particular trade. Okay. Now you also have to understand your price to volatility correlations when you're trading this type of trade. And so again, I recommend that you do your own studies and note the rate that the volatility changes relative to the price. You'll find there's an inverse correlation, and you'll find your own averages. Okay, so that way if your underlying moves down 10%, you'll know how much you want to model into the Black-Scholes or whatever pricing model you're using. And these are a lot of steps that your beginners won't ever take. So they'll just be using the software and they'll just guess. They'll be like, well, what if vols go up 1? What if vols go up 2? But you can actually do the, collect the data and create your own empirical data study sets and determine the proper amount that your volatility is going to change. So spend time and do that yourself. And then that way, again, you can see what your VAR is, the value at risk. Again, they were, I don't know if Karen was aware of all this information, so, it's hard to say if she knew what her VAR was, really. But you really want to understand all these things. The lack of research and development. So again, I don't blame Karen. There's, throughout the industry, the tools really aren't just readily available to the retail trader. And, for example, she probably didn't have any software to run her queries, and just run whatever her Strangle method and adjustment plan was. She probably had to do that manually. I develop the automated the back testing systems and trying to get out the software finished so I can offer it to the public. But the thing is, I know what I know the difference. I know what it's like to have those automated tools and to not have them. And so as far as I know, she was working without them. And so unfortunately, she didn't have those tools. She needed, to really test her method to figure out the exact amount of margin to use, the best delta to sell, the best stop loss to use, and all that. So I think they were just winging it, and that's not really a great plan, as you can see. And again, I don't blame her. And there's so many, those guys, Thinkorswim, they advertise like crazy, TD Ameritrade, that their software is, the elite platform. Just look at their website. It's just nonstop touting. And then not only that, they're on TV like every 5 minutes. So you'll even see them on the NFL network. How many have heard this one? Luck is in the air, right? So, Karen here, she, bid into all the hype, and she probably believed she was using like the best options analytics, but just a lot of things really kind of led to this problem for Karen. So, in my opinion, she's running a charity. A lot of people online are already saying, oh, that's like a common deceitful whatever system, like part of the fraud game she was doing. But others are, maybe she was sincere and sincerely trying to help with her charity and things. And maybe she just became a victim of the analytics, a victim of the margins, not understanding the higher order Greeks, because even though she paid for her education, Invest Tools and the other mentoring courses she took did not teach her about VAMA, higher order Greeks. So she was, fully unaware of those risks. So anyway, those that were skeptical about our back test that we did a few months ago on the short strangle, hope you can see now that they're actually pretty accurate, just as accurate as they could be given the data that we were given. None of those back tests were, again, fudged or tampered or anything like that. They are what they are, and they're derived from, the authentic CBOE historical data. And I just plugged in their formulas and tested them, and those were the results. And then you can see real results now, because they're unfortunately becoming public record on Karen Burton's hedge fund. So thank you, and hope you learned a little bit about the risk of the short strangle in this video presentation.